Okay, so in this particular chapter, we're going to take a few minutes to talk about some of the basic building blocks of managerial accounting. We're going to review service merchandising and manufacturing companies, talk about different kinds of costs, the value chain, and review the financial statements for various types of organizations. Okay, so companies typically generate profits through one of three basic business models. They're either providing a service, they sell merchandise, or they manufacture products. So service companies are in business to sell intangible services such as healthcare, insurance, banking, consulting, rather than a tangible product. Service firms now make up the largest sector of the U.S. economy. Because these types of companies sell services, they typically do not have inventory, which you see here. Service companies incur costs to provide services, to develop new services, advertise, and provide customer service. Salaries and benefits typically make up a majority of their costs. So that's one area where service companies need to pay extra careful attention. Manufacturing companies, or companies like Walmart and Best Buy, they sell tangible products that they buy from suppliers. So retailers are an example. They sell merchandise to consumers, and wholesalers are typically the middlemen. They will function between manufacturers and retailers. They buy products in bulk from manufacturers, then mark up the price and resell those to retailers. An example, you may think of Sam's. They function as a retailer. They sell directly to consumers. They also function as a wholesaler because they will sell to businesses who then turn around and sell directly to consumers. Now, since merchandisers sell tangible products, they do have inventory. Typically, they have one type of inventory, which includes the cost of inventory, or the cost that they pay for the merchandise, plus all the costs required to get the merchandise in place and ready to sell. So, for example, if they incur freight costs or import duties or tariffs, those are all included in the cost of that inventory on their balance sheet. Manufacturing companies, they use labor, plant, and equipment to convert raw materials into finished products. And we're going to get into more detail about these in just a minute, but they typically carry three types of inventory accounts on their balance sheet: raw materials, work in process, and finished goods. Now, the activities in a value chain are the activities that add value to products and services. These activities use company resources such as time and money, and the value chain includes all the activities from the inception of a product idea through final delivery to the customer. The value chain incorporates 6 major activities. These would include research and development. So these will be the costs associated, for example, with developing a new fuel-efficient and safe car if you're a company like Toyota. The design process, which is the specifications for the dimensions of the engine and characteristics for the new car. We've got production, which might include the sheet metal used to build the car and the assembly line workers' wages to actually go ahead and build that car. Marketing, which includes the advertising and promotion costs. And distribution, which would be the actual delivering of the car to the customer. And finally, you have customer service costs, might include providing warranty service for that particular car. So a question that typically comes up is, how do companies define costs? Well, they start with something called a cost object, which is anything for which managers want to separate a measurement of cost. For example, we could have individual units, so for a specific custom ordered car, or different types of models like a Prius versus a RAV4 versus a Corolla, alternative marketing strategies, geographic segments, departments, all those could be considered a cost object. It's just how it's defined for a particular manager. Now, a direct cost, you see here, is a cost that can be directly traced to a particular cost object. For example, if we're producing a car, a steering wheel used in the production would be considered a direct cost. Now, an indirect cost is a cost that cannot be directly traced to the cost object. For example, the cost of lubricants used in the manufacturing process on the equipment, or plant manager's wages, because the plant manager is overseeing multiple products. So those wages are not traceable back to a single specific product. So if a company wants to know the total cost attributable to a cost object, it has to assign all direct and indirect costs to the cost object. So they're attaching a cost to the cost object. Direct costs are assigned by tracing these costs to specific units. And because indirect costs cannot be traced, they are allocated to the cost objects. So you can see here the direct costs are going to include direct labor and direct materials, and the indirect costs are what we call overhead. So if I switch here to the next slide, you can see here we have something called direct materials, direct labor, and manufacturing overhead. These are the total manufacturing costs associated with producing a product. So let's talk about each one of those in more detail. So direct costs are raw materials that become an integral part of the finished product and whose costs can be conveniently traced to it. For example, we have a car here, so a radio installed would be an example. We also might consider the tires, the engine, upholstery, carpet, dashboard instruments. Any of those that can be directly traced back to the specific item would be considered direct materials. Now it can also include the freight and import duties to particular products. Those would be also considered direct costs to the vehicles. Now, we also have a category called indirect materials. Those are materials that are used in the plant that are not easily traceable to a specific individual item. For example, janitorial supplies, oil and lubricants for the machines, or physical components of the finished product that are very small and minute. And we will consider that part of manufacturing overhead, which we will detail here in just a second. Direct labor is the cost of compensating employees who physically convert raw materials into a company's products. So these would be employees who actually work on the assembly line, who are converting the raw materials into what we call finished goods. Now we also have something called indirect labor, which would include the cost of all employees in the plant other than those employees directly converting the raw materials into the finished product. So for example, you might have plant supervisors, janitors, security officers, forklift operators. Again, they're working on multiple products, so it's not specifically on, say, one production line. So that's indirect labor, and we will have to allocate that out later. We'll spend a great deal of time learning how to do that. And again, indirect labor, indirect materials are all part of what we call manufacturing overhead. So manufacturing overhead consists of all manufacturing costs other than direct materials and direct labor. So these are costs that cannot be conveniently traced to products. Like factory overhead examples might be salaries. Again, we mentioned for supervisors, janitors, it could be depreciation on the building, taxes, all of those associated with production that we can't directly trace back to a specific item. Now, costs can also be classified as period or product costs. So product costs include all the costs associated with making a particular product. So more specifically, that's going to include your direct materials, direct labor, and manufacturing overhead. This is consistent with the matching principle. So product costs are recognized as expenses when the products are sold. So it will sit here as a debit and inventory on our balance sheet, finished goods inventory, and at which point it gets sold, it transfers over to our income statement as cost of goods sold, the cost of the merchandise that we're selling. So all manufacturing costs are going to be treated as product costs. Now, period costs here include all selling and administrative expenses. So these are costs are expensed on the income statement in the period in which they're incurred. So all selling and administrative costs we might consider like our home office costs, human resources, accounting, people that aren't generating any sales. They're considered to be period costs. So usually could also be selling expenses. So your salespeople. And the rule of accrual accounting applies to period costs. So for example, administrative salary costs are incurred when they're earned by the employee and not necessarily when they're paid, but they will be expensed when incurred, not necessarily when paid. So those will be expensed in the same period in which they're incurred. So here's just another way to look at what we discussed a second ago with product and period costs. So inventory of product costs only include the costs incurred during the production or purchases stage of the value chain. Inventoriable product costs are treated as an asset or as an inventory until the product is actually sold. So you can see here it's going to sit on our balance sheet as inventory until the point in which it's actually sold. Now when the product is sold, all those costs are moved from inventory and expensed into cost of goods sold. Also, you can see here the period costs are going to be expensed when incurred and sold as operating expenses. Now, if we have inventory that's sold, that will be recorded as cost of goods sold in the period of sale. Now, this is just essentially a recap of what we've talked about so far. We've got our service, merchandising, and manufacturing companies. You can see if they have any inventoriable product costs. Service companies typically do not. I would like to point out here that for merchandising companies, the cost of paying freight to get the merchandise in, and or if they have to pay import duties and customs, that does get included as part of the cost of the inventory. Manufacturing companies, remember, they have three types of product costs: direct materials, direct labor, and manufacturing overhead. Now, the income statement for a manufacturer is very similar to what we learned about as a merchandiser in financial accounting, except for the cost of goods sold section. So if we take a look at the cost of goods sold section for a merchandiser versus a manufacturer, you can see here, merchandiser, we started with beginning merchandise inventory, added to that cost of goods purchased, subtracted our ending inventory to get cost of goods sold. Now for a manufacturer, it's slightly different. We start with something called beginning finished goods inventory. This is inventory that's completed and ready for sale. We add to it the cost of goods manufactured during the period and subtract our ending finished goods inventory to get cost of goods sold. So what it looks like, the actual income statement cost of goods sold section between the two companies, you can see here how, again, manufacturer starts with beginning finished goods, adds cost of good manufactured to get cost of goods available for sale, subtract ending finished goods to get cost of goods sold. So slightly different than what we saw for a manufacturer, or merchandiser, excuse me. Now I'm sure you're wondering, well, how do you calculate cost of goods manufactured? We need that in order to figure out our cost of goods sold. And the way that's calculated is we look at beginning work in process inventory. So work in process is a product that's been started, but it's not completed. So if we were thinking of a car manufacturing assembly line, we would look at cars that had been started, so they're in process, but they're not complete. Maybe they have the wheels on and the interior complete, but it's missing an engine. Something that's not complete and ready for sale is considered work in process, but it has been started. Add to it our total manufacturing costs, which are our direct materials, direct labor, and manufacturing overhead, to get our total cost of work in process. Subtract the ending work in process inventory, and that'll give us cost of goods manufactured. Here's an example of a schedule of cost of goods manufactured. So again, we start with beginning work in process, add to it direct materials, and you can see how we're calculating that here. Take your beginning raw materials, add purchases, and subtract ending raw materials inventory to get direct materials used. Then we've got direct labor, manufacturing overhead, which consists of all these variety of items, and that will give us our total manufacturing cost: direct materials plus direct labor plus manufacturing overhead. Subtract our ending work in process to get total cost of goods manufactured. Also, if we look at the balance sheet, the difference between a merchandiser and a manufacturer, here we've got just one category of inventory for a merchandiser. We have three categories now of inventory for a manufacturing company. And you can see the manufacturing cost flows. So again, raw materials are just the items that have yet to be started into production. So for a car, it could be tires, it could be windshield, it could be a radio, everything that individually needs to go into making a car. And then we add labor to that to get work in process and manufacturing overhead. Once that's completed, it moves into finished goods on our balance sheet. When it's sold, it transfers over to cost of goods sold. Our selling and administrative expenses aren't involved in making the product, so they're treated as period costs and reported on the income statement for the period the cost is incurred. So let's see, if we're going to calculate direct materials used, we would have to start with our beginning raw materials, add purchases, add freight or customs duty fees. That will give us materials available for use minus our ending raw materials inventory to get direct materials used. Also, we can look at the flow of cost for materials inventory, which is shown here in a T account format. So each inventory account is going to start with a beginning inventory balance. Now, inventory is an asset, so it will start with a debit balance. Then we subtract the ending inventory balance to find out how much inventory passed through the account during the period and on to work in process. So we take our beginning inventory, add to that the direct materials purchased plus freight. That gives us our ending, our direct materials available for use. Subtract our ending inventory to get direct materials used. So it's kind of working backwards there if we're not given that information. The flow of costs through work in process inventory is shown here in T account format. So the work in process inventory account starts with the beginning inventory balance, and then it adds direct materials, direct labor, and manufacturing overhead. And it subtracts the ending inventory balance to find out how much inventory, if we were working backwards again, subtract ending inventory to find out the cost of goods manufactured and sent to finished goods. We can also see here the flow of costs through the finished goods inventory account in T account format. Finished goods inventory starts with the beginning balance and adds to it the cost of goods manufactured. When the products are sold, the cost of finished goods is transferred out as cost of goods sold, hence the credit, and then we're left with ending inventory. Now let's talk a little bit about controllable versus uncontrollable costs. So controllable costs are costs that managers can influence or change. Uncontrollable costs are costs that management cannot change or influence in the short run. So for example, if we were thinking again back to Toyota, management can control costs of research and development, design, advertising, but they can't control the cost of property taxes and maybe insurance on its existing plant, at least not in the short run. They can't modify those costs. So we really want to hold managers responsible for what is within their control. We also have something called relevant versus irrelevant costs. Relevant costs are costs that differ between alternatives. They're what we call differential costs. Irrelevant costs do not differ between alternatives, and they can also be referred to as sunk costs. So sunk costs are costs that have already been incurred. Management often has trouble ignoring the sunk costs when making decisions, even though they should. Let me give you an example. So let's say you're trying to decide whether you want to sell your old car or buy a new one. So the relevant cost in this decision would be the cost of repairs to your old car, maybe a trade-in value, and the cost of a new car. Those are the costs that will differ between the two alternatives. Now, the amount you paid for your old car at this point is irrelevant. It's a sunk cost. It's already been incurred. We can't change it. So sometimes that's a hard mental barrier for managers to overcome when they don't want to get rid of old equipment because they paid a lot for it. Also, when making decisions, management must also consider qualitative factors like employee morale, and if possible, consider that in addition to the differential costs. Okay, now let's talk a little bit about how manufacturing costs behave. Most companies have both what are called fixed and variable costs. So variable costs change when the activity level changes. Total costs remain unchanged when the activity level changes. So let me give you an example here. So if we have a fixed cost, that could be like your basic cable bill. It doesn't matter how much viewing you do, you are going to pay the same amount, maybe let's say $100 a month. Maybe you're on vacation, you don't watch any cable that month, it doesn't matter, you're still going to pay $100 per month. Now, the interesting thing about a fixed cost is that, let's say with your cable bill, as the more shows you watch, the cost per show actually decreases. Total variable cost, on the other hand, would be based on your viewing habits. So for example, on-demand movies. Every time you watch an on-demand movie, you're paying, say, an additional $5 for that. So it is a variable cost. And the total variable cost remains constant. So for example, the cost per show is always going to be $4.99 per movies watched. So if we look at the relationship between variable and fixed costs, in total, variable cost changes as activity level changes, but the per unit cost remains the same. Kind of the opposite with a fixed cost. Total fixed cost remains the same even when activity level changes, but the fixed cost per unit goes down as the activity level goes up. And here's just a quick example of that. So total cost is going to equal your fixed cost plus your variable cost. And if fixed costs are $20,000, variable cost per unit is $50 per unit, and we manufacture 100 units, well, the variable cost is 100 times 50, which you see here, and that would be $5,000. The fixed cost is 20. Add those two together, we get a total cost of $25,000. Now, the average total cost will depend on the number of units. So if we have a total cost of $25,000, we produce 100 units. That's an average cost of $250 per unit. We also have something called the marginal cost, which is the cost of producing one additional unit. So because total fixed costs don't change, the marginal cost is usually the same as the variable cost. So if we make 9,000 units and then we manufacture 9,001, the cost difference between 9,000 and 9,001 units will be the marginal cost, which is typically the variable cost per unit. And that does it. Thank you.